Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, like, and share these videos. In last night's video, I spent a lot of time and went through a lot of detail talking about the expectations for the current sequence that we're in. While my expectation was that we might see a 2 to 3 day decline based on the market grid signal, the markets would have nothing to do with that, and we saw a sharp expansion in the rally right into the close today, pushing up to the 3232 level basis the S&P 500. I discussed in last night's video that the current sequence is expanding. But everything changed when Friday gapped higher and moved 80 handles higher, expanding volatility and triggering an expansion move to the upside. But today there is a significant technical event. This will be a key pivot point on the charts, and we'll find out whether we're going to extend further and move up toward the 3279 level before finding the top of this particular sequence. I also discussed in yesterday's video the WaveTech short-term database was 89% long. We saw even more buys for Tuesday morning, about 140, as it continues to get even more overdone than what I've seen it for quite some time. There's still a high probability for a reversal. I'll go through in the technicals section shortly what to look for when we finally will see a top of the sequence. Most likely, market participants are going to be looking to Wednesday CPI, Thursday PPI, and the unemployment claims for some basic guidance from a fundamental standpoint. While fundamentals haven't had a lot to do with what the markets are doing, we are seeing some focus in the last couple of weeks that things are coming out better than expected. One of the other things I noticed is a lot of stocks that have been hammered down. Stocks like Hertz and some of these companies virtually bankrupt are seeing sharp rallies as market participants are looking to cheap to find ideas to buy. This is primarily because how overplayed all the other stocks are. It's pretty difficult to position yourself in some of these stocks if you didn't own them from much lower. On March 26th, we had a primary short-term buy signal on our models at 26.30. It exited at 28.40 and then re-entered the markets on 5.15 at 28.48 and continues to be long. So the general sentiment from our models viewpoint is that the markets are still bullish, even though we're nearing some of the peak levels from an Elliott wave viewpoint and from a price projection viewpoint. Oftentimes these things will extend, but I think we're really close based on the overbought and overplayed database, as well as some other sentiment numbers. Tonight we'll review the S&P 500. I want to take a quick look at the VIX, and also we'll be going through the 10-year treasuries as well as the US dollar. Let's take a look at the charts and see what they're telling us for tomorrow. Starting with the S&P cash, yesterday was an interesting day. When we traded through the R2 number, it accelerated into the close, printing a high of 3233.13. Yesterday's RXT number on the market grid was 3233.41, virtually exact hit on the extreme. The key to the day yesterday was to break over 3213.67. Market accelerated once getting through there. Today, a similar pattern will be important to watch, and I talked to you about in the intro that I would discuss what we need to see a top of the sequence. Now, I discussed in yesterday's video that I believe we're in a wave 3, and the targets are 3228 to 3279 zone. Now, we breached that on the close yesterday. We're likely to continue toward this 3279. This is going to represent a top of a wave 3. Now, we could see further extensions. The way this market's trading, anything's possible. There is a 55-day cycle I'll show you here in a minute when we look at the futures hitting for today, Tuesday, and this could represent the possibility of a reversal. This is what we're going to need to see a top. We're going to need to see it print up into the R1, R2 level, which is going to be 3242 32.52. If you notice on the market grid, Tuesday's RXT is 3273.56. That maps pretty well with the 32.79 high. I don't think we'll get that far. The way we've been trading, this market is so explosive and the stampede just continues. What we want to see to determine the top of this wave 3 is where it prints up into this R2, R3 number and then reverses and closes lower on the day. So until we see a pattern like that, this thing's going to continue to have some buoyancy and continue to have an underlying bid. Let's take a look at the futures. The dots that you see on the screen are a proprietary tool of mine which look for Fibonacci cycle clusters. And when these come up, they tend to be significant. The last two that have suggested a sideways movement, one of them had a minor 3 or 4 days. Now, with us being as extended as we are in this market, tying everything together that I talked about in the entry with the WaveTech database on a short-term level being roughly 90%, and all the other sentiment indicators, including the VIX, which I'll go through in a minute, are sitting at levels that are likely to see a potential reversal. Until the market actually experiences a reversal, there's not going to be any way to determine it other than on an intraday basis. You might see a reversal off the market grid, off an R2 or R3 number. We'll see how this all unfolds. The futures have a much different pattern. I've been discussing this over the past couple months as they tend to have much better accuracy in looking at these turning points. Keep an eye looking for a reversal. Other than that reversal, markets are going to continue to have underlying bid moving up toward the top end of these ranges that are printing on the market grid. The interesting pattern on the VIX is that we're hovering right above the 200-day moving average right now. It continues to hold, but if you look at the PPMs, they're all starting to show that they're bottoming. So this tells us not necessarily that there's a huge spike or a big decline coming, but there appears to be a decline setting up. And the next couple sessions are going to be super critical to this pattern. Now the VIX is going to have to get back above around 2850 before it'll give any kind of signal from a model viewpoint. Right now the models are neutral. It's not telling us that this is going to happen, but this is what we're going to want to watch over the next couple of days. Taking a look at the chart of the volume, this is daily volume going back to the beginning of the year. Now I want you to notice that in the middle section here, there's a hump where volume spiked up between 9 and 10 billion shares a day. And we're seeing another spike starting to form right now. But if you notice this period of time, I don't have this on S&P chart, but if you notice where this happened, it was right at the peak of the decline. So as the market came into the low on the 23rd, this is where the volume started to slow down. Now, a lot of folks have different views on volume than I do, but this is significant. These are very climactic periods of time when this happened. Volume stays up over 8 billion. This is going to put an exclamation point on how overdone this market is, as it could end up to be a capitulation phase of this market before we finally reach the top. Now, having said that, the Fibonacci objectives and everything I talked about in yesterday's video and the configuration I discussed in the S&P a few minutes ago is still valid. This is setting up a larger pattern to pay attention to as we get to this point. As I just mentioned, when we were looking at the S&P 500, we want to watch for a reversal of one of these key numbers in the market grid over the next couple of days, looking for this cycle that I discussed, as well as the frothiness of the database, and everything is pointing to this market being overdone. Now, having said that, what I'm looking for, as I mentioned in yesterday's video, is once the top of this wave 3 is formed, then we're going to see a pattern set up that could take as much as 2 weeks to set up before we are going to see any type of extended move to the upside. Now, if you recall, there's still a projection to the upside. If you didn't watch yesterday's video, watch yesterday's video as I discussed the pattern and the potential on the upside for the market to go up as high as the 3382, 3400 level, which would represent a move to test and potentially make a new high. We'll continue to watch this closely. From a trading viewpoint, it's going to be very tricky here until we see that reversal that I talked about. Taking a look at the daily chart on the 10-year, we'll see that there was a buy signal that came out on this breakout on 5/18. The buy signal is suggesting there's going to be higher yields. We did print up to 0.95. I'm still expecting to see them move much higher in the pattern. Now the PPMs are still accelerating. This is telling you that higher yields are still highly probable. Now the short-term rates are staying flat, but we're seeing these longer-term rates actually start to move. Let's take a quick look at the yield curve. The yield curve has been steepening substantially since around March 9th. This was the point where the Fed went nuclear and started to buy corporate bonds, municipal bonds, but the treasuries have been allowed to float higher. As I discussed on Friday's video, there's something going on with the treasuries, the steepening of the yield curve, and I'm going to go through the Dow real quick, and we're continuing to see weakness there. It's interesting, there's two scenarios here that are likely. The first one is that the flight to quality that came from overseas buying bid the Dow and bid the bonds, causing yields to drop. Now it looks like we're seeing improvement in Europe, and as the whole world opens up for business again, maybe it's just folks bringing their money back. I discussed the other day, what if the Chinese became a big seller and then they were going to weaponize the treasuries? I don't know that that's going to happen. Everything seems to be quiet right now, at least from a news standpoint. There's no real talking going on between the U.S. and China that I've heard anyway. I haven't seen anything significant. Let's take a look at the U.S. Dow and tie all this together. Looking at the Dow on a daily basis, we see the continued decline, but the trend is trying to bottom here. So it looks like there's going to be some stability as far as the U.S. Dow and the treasuries are connected. We're likely to see the Dow move back up toward 97.50 or so, maybe 100 points, which would be about 0.5% to maybe 0.75% on the upside. Not a material change in the trend, but we could move up toward that 10-period moving average. It is declining at a 0.23, which tells you we're right at a downtrend level. So I expect to see some stability in that as well. I didn't mention this market, but since I just covered the Dow, there's just going to be a quick mention of the gold. Gold continues to be very sloppy and drifting in this sideways pattern. The PPMs are continuing to be in a very unorthodox, not signaling a buy signal or a sell. So we've just been locked in a sideways range. You really have to go back to probably mid-April in this drifting sideways pattern. So there's nothing there. A quick look at the weekly chart. You'll see we've traded back below the 10-period moving average. It's hovering above the support on the 21-week moving average, and the PPM2 is at a plus 0.34, which is trend level. So the 1684, 1690 level will continue to be major support at this level, and we'll most likely trade between 1690 and 1724, maybe as high as 1750. This will complete the video for tonight. Thanks for watching. We'll talk to you tomorrow night.